I've got inflation that takes a cut out of that. I got my financial advisor for their fees, and I got my taxes. I cannot get anywhere. I'm staying even. That's why your parents are dead broke when they're 65, because they pay taxes out of their retirement account, and then they can't live because what is left? When I was 19 years old, $100,000 a year was a good salary for somebody that was a teenager or in their early 20s. Now that's financial mediocrity because inflation has swallowed that. Where that lands you is coincidentally in the very assets that financial advisors put you in. Why earning $100,000 a year feels like minimum wage. In this video, guys, we're gonna go over why a lot of people feel stuck even when they're making $80, $100, $120,000 a year, and what you can do about it to start getting non-stock market-like returns. We're talking 2, 3x on your net worth every few years. Today, I'm gonna show you the actual stats, the results, the type of investments you're gonna wanna start participating in, how to hedge inflation, put yourself set up in a good position against the US dollar so that you do not keep losing to this financial system that you have unfortunately been gifted. So the first thing that we got to just break down, this is a common myth, is 100K a year is a lot of money. No, it's not. When I was 19 years old, $100,000 a year was a good salary for somebody that was a teenager or in their early 20s. Now that's financial mediocrity because inflation has swallowed that. If we go back just 5 years, okay, in the last 5 years, the dollar has lost 25% of its purchase power, okay? So what actually you could buy for $75,000 back just a few years ago, it actually takes $100,000 of those same dollars to buy that good or that service. Now, who pays that? You do as the consumer. So if you're getting a 2% a year raise and you're going from $98,000 a year to almost 100 to 102,000 to 104,000 to 106,000, you're not keeping up with the rising costs of gas, of energy, of your mortgage, of your rent, of your car payments, etc. It just doesn't work. So let's break down, what does 100K get you today? And then how do we get out of that? How do we hedge inflation? And how do we multiply net worth? Because in a few minutes here, I'm going to show you exactly what I do to do 2 to 3x every few years on my money while hedging inflation and not being a burden or a victim to the dying, crumbling US dollar. So on 100K, let's say you're fortunate enough to live in one of those states that does not have income taxes. You have about $80,000 a year left after your cumulative tax bracket, after Social Security, which you're never gonna see, after L&I and all the other fake stuff. Now you got 80K left. So now we have to figure out, where does that money go? Where are you putting it right now? Well, the average rent on a monthly basis in the United States, about $1,800 a month. We're gonna round that to 2K just to keep numbers around, and that's 24K. Let's just say that includes your utilities, your gas, your electric, your internet, all that stuff. So you got 24K right there. Average car payment in the United States is just over $700 a month, okay? So we're gonna put that at about 8K right there. Now you got food. Let's just say that your food is $1,500 a month. That's not very much. That's what, 45, 50 bucks a day? That's not very much, okay? That's not even a quality breakfast and lunch dinner. That's a couple, Costco trips for some stuff that has soybean oil and MSG and canola oil and all of this synthetic stuff and is highly processed. So you got $1,500 a month there. That is 18K a year, okay? Then you got your car insurance. That's, let's just say, 2K a year, okay? We haven't included health insurance. We haven't included anything like that at all. Now, most Americans in this category, they take a couple vacations a year. That's $5,000. Now, this does not assume that you have kids or anything else. Oh, we got to put a couple $1,000s a year clothing. All right, there's our expenses. We've got 24, 32, 42, 50, 52, 50, 78, 59. We've got about $60,000 in expenses here. Now, I have left out health insurance. I've left out other leisure stuff. I've left out social. I've left out everything else, including a few bills. But we've got $60,000. Now, keep in mind, you only had 80. Realistically, you might live in a state like California or Washington or another area that has some other form of tax. So you only have $20,000 a year left. What can you get with $20,000 a year? So we've got 20K. And a lot of you guys are saying, yeah, but like, I have a boat, I have a motorcycle, I have student loans, I have credit cards, I have all these other debts. So the reality is, most of you, if you make 100K a year, you probably are not saving $20,000 a year because you're spending on bad debts, you're not disciplined, and you're choosing to get rid of that money and not have it go to work for you. So once you make the choice to not put what you have left into bad things, now you got 20K to work with. What can you do with 20K? Well, I'm gonna fast forward to what I do. I'm in private equity and I'm in assets that require you to have a little bit more capital in that, where you can do 2 to 3x. And coincidentally, you get paid just underneath that threshold, right? Now, is that a coincidence? I don't think so. Where that lands you is coincidentally in the very assets that financial advisors put you in. Stocks, bonds, mutual funds, ETFs, maybe you fund an annuity, fixed index annuity, life insurance, term insurance, IULs, index universal life policy, VUL, all this stuff, which you can do a few $100s here, a few $100s here, a few $100s here, a few $100s here. You can dabble. Be diversified by dabbling. And what does that do? It gets you in that 8 to 10% a year range. Now this is what we have to think about. At 8 to 10% a year, let me know in the comments. If you're making 8 to 10% a year on your current capacity to invest, are you going to be wealthy in the next 5 years? Are you going to be wealthy in the next 10 years? Are you going to be wealthy in the next 15 years? Are you going to be wealthy in the next 20 years? Answer me that in the comments. I think the answer we can all say is, fuck no. And you're not even thinking about taxes and inflation at this point. We have to remember that the dollar, since it started getting printed in 1913, fiat currency only exists to be backed by the government, whatever that means, has lost 98% of its value. Meanwhile, this gold coin, if I took $1 of gold from 1913 and $1 of dollars, this dollar is still worth $1. This dollar of gold is worth $250 today. So this has lost 98% of its purchase power. This has gone up 250x. If I'm making 8 to 10%, I'm not going to get anywhere. I've got inflation that takes a cut out of that. I got my financial advisor for their fees, and I got my taxes, okay? So I'm losing. I cannot get anywhere. I'm staying even. That's why your parents are dead broke when they're 65, because they pay taxes out of their retirement account, and then they can't live because what is left, they're still paying taxes on, and inflation ate it, and they locked their money until they were 59 and a half because they were told they couldn't touch it without a 10% fee. That is the cost of keeping your money in paper and making 8 to 10% a year. So the question is, what's the alternative? What's the strategy? How do you actually start multiplying by 2 to 3x? And I'm going to answer that in just a second here. Before I do, if you're brand new to the channel, make sure to subscribe. I always drop videos on how to build your wealth like a capitalist, reduce your taxes, take them down to as low as 0 legally possible without deferring or saving it for a rainy day, and how people just like you are multiplying their net worth, building cash flow, decreasing their taxes, and far outperforming a retirement account or that mainstream cookie cutter financial advice. So make sure to subscribe. So now the question is, how do we do 2 to 3x, okay? Well, you want to get yourself access to the institutional investments that the banks, the insurance companies, and the private equity companies buy. These are not the assets that you see advertised to you. You're not going to see the 1-800 number. You're not going to see the things advertised on TV. You're not going to see them run on social media. You're not going to see them advertised, okay? They're kept amongst friends and family and the big bankers and the businesses and the institutional money. Now, if you're lucky enough to find these types of assets, they usually have a barrier to entry, somewhere around $25K. So the question a lot of you guys are asking right now is, well, Ben, I don't have $25,000. How can I do this? My point is, stop dabbling. It's better to save. Keep that dabbling in gold. Keep that dabbling in silver, where you're not exposed to inflation and where we already know silver and gold outperform the dollar year over year over year. They hedge inflation while the dollar crumbles and you continue getting paid in it. You choose to convert what you're saving into gold and silver that outperform the dollar, okay? So dabble there. Put your dabble money over here instead of fucking around in stocks and ETFs and mutual funds and chipping away, making no impact for several years. Be disciplined and keep it in gold and silver, okay? That is your savings. Because the $10,000 that you save in gold and silver, it's gonna be worth 12, gonna be worth 13, gonna be worth 15, going to double in a fairly short period of time without you having to put in that level of capital to make it double, okay? That's just leverage. That's just saving smart in gold and silver. Now, we want to get to the point where we have at least $25,000 of it. And you have a couple options there. You can borrow against it You can get a metals-backed line of credit, metal equity line of credit, okay? Or you can sell at a high and get into private equity deals. You can do a couple things. Another option you can do is you can get a bank-structured type of insurance policy, bank-owned life insurance, not an IUL, a VUL, or a retail whole life that your shitty financial advisor is going to sell you. An institutional grade whole life policy, a fraction of a decimal of people have this, and less than 100 insurance professionals in the entire United States even know what the heck it is, let alone sell it, okay? So you get access to this. And yes, we know those types of advisors. We work with a few. We can help you out with that. So this right here is an institutional structure, what you call a high early cash value whole life policy. And the problem with life insurance in general, and I'm not an insurance salesperson, I don't get paid to say this or anything. My former company was a marketing firm where we generated over 20,000 appointments for America's top 10% of independent money managers in the United States. That's where I learned the amount of financial fraud, the scam, and the mediocrity that the financial industry is. Selling annuities that make 7% or 8%, that make the advisor more money in day one than it'll make you in a decade. Selling life insurance where there are 50 to 130% commissions, that is robbery, okay? So I can expose that industry from the inside out. And at the end of the day, most financial advisors have no personal wealth. They're not invested in the private equity assets I'm about to teach you guys about. How they get paid is by making money off the fees they charge you and commissions from the insurance company. How this works here is your cash value, and here is your insurance. And you're prioritizing a structure where you give the focus to the cash value and the minority to the insurance, okay? And usually in these structures, you take somewhere around 25K minimum, right? And you invest in a HECV, and you do half now and half a year from now. And you have one insurance cost that you're paying now and about an equal chunk, give or take, another year later, okay? And those are the only mandatory required insurance costs. You're paying them really upfront. And then the focus goes on this cash value. And in this cash value, you get two things. You get a dividend, and then you get a guaranteed return. This guaranteed return right now is 2 to 4%. The dividend in the last 50 years, the average has been 8%. Right now, it's about 6.6%. Now that dividend is income and estate tax free. When you combine these two, you can have growth, even taking into account the insurance costs, 6 to 14% annual return, okay? So every year now, those returns tend to get a little bit more, a little bit more, a little bit more because you left the insurance cost in the past. When you earn that dividend and that guaranteed return, right, it goes back into the cash value, just like this, and it levels it up more and more and more, and the cash value rises. Now, both of these you can borrow against. So you own the asset, your gold and silver. You own the cash value insurance policy, but you have a line of credit against it. Now we have to deploy where we can do 2 to 3x. Are you guys with me so far? If you're loving this video so far, just drop a thumbs up in the comments or just say, hey, loving it. If you have any questions, let me know in the comments. I'll do everything I can to answer those comments. Now for this next part, I want to show you actual results. No theory, no BS, just real results, because that's all anybody gives a shit about. So the two areas that I invest are oil and multifamily real estate. Now, let me just address something real quick. Multifamily real estate, I do this 100% passively. I don't manage a property. I don't worry about tenants. I park my money with a reliable operator that's done several deals, full market cycle, that manages over $300 million of multifamily. As a matter of fact, I have my own multifamily fund and my own oil fund that folks just like you are able to invest in. And we have the track record and the results to show what we've been able to produce for clients. So on multifamily, to give you a couple statistics, we have over $300 million of multifamily under management. We average a 32% internal rate of return for clients. We have over $100 million of investor capital, and we've never lost a penny of it, okay? So those are some of the results. Now in multifamily, most deals are underwritten on a 5-year cycle, okay? And we do two different types of deals. We do cash flow, and then we do development, okay? Cash flow deals, general rule of thumb, somewhere between a 1.8 to a 2x return and anywhere from 8 to 12% cash flow. Development deals are usually a 2.3x to a 3x return, no cash flow, because we're building an apartment complex for the ground up. I'm going to show you results. I'm going to show you examples of all of these. On the oil side, we're looking for a 1.8 to a 2.2x, and it could be as short as 4 years. It can be as long as 7 years, okay? And those are the types of deals that we're doing here. Now the oil, this kills. income taxes. The multifamily is passive income, okay? So max tax bracket on this, 20%. We use something called depreciation so that we can lower taxes even further. On oil, you get a massive upfront write-off through something called IDC deductions and something called TDC deductions. And then you get 15% of your cash flow that cannot be taxed because of something called the depletion allowance. Those are your tax incentives here. So let's break this down. I got my whole life, I got my gold and silver. I can leverage both of them, I can borrow against them, and every time I go to repeat it, my cash value is increased, I can level up that line of credit and keep repeating the process. I can do that on both those, gold and silver, as well as my HEC whole life insurance. So now, oil, take a look at this deal popping up on screen here. This is a historical deal. It's been paying out for a little over the last 3 years. The average cash flow during the duration of that fund is a little over 22% average cash flow. Yes, I'll beat your financial advisor every time when it comes to cash flow because I actually understand how to build wealth. Now that deal has been also averaging about $65 a barrel on oil. So I also want to be very crystal clear. We're not talking about the current oil prices where we're getting $90, $100, $120 a barrel. We're talking about the average history. We're talking about the average past. 22% in average annual cash flow. That is a real deal that we're paying out real cash flow without fail year over the past 3 years. Now this one you see coming up on screen, this is the TCN Energy Fund number 1 for this year in 2026. Now, we have 26 oil wells in this fund. Here's an example of 18 of them. Now, out of those 26 wells, 15 of them are already online, meaning they're already producing oil, and we already own some of these wells in our previous funds. So it's very predictable for us to know how much oil, how much natural gas, what are the decline rates, what are we getting paid on these. But because we already own these wells, we've been getting paid on the high energy prices since this whole Iran war broke out in January. We've been capitalizing on today's energy prices. Now I'm gonna fast forward to these projections here. Because we've been doing this for a very long time and we have dozens and dozens and dozens and dozens and dozens of wells, it's very easy for us to underwrite and go, hey, because we know what the oil is, because we know what the natural gas output is, because we know the underwriting on these wells and how much they produce, anytime we buy more position in a well and we offer that fund to our investors, we have some pretty good math behind our projections and we have history to look back to, just like the 22% annual cash flow I just showed you. So when we look at that, it becomes fairly predictable to assume this deal is going to do somewhere around 1.8 to a 2x return. So if you look at these projections here, this is based on a $100,000 investment. Clients could come in at 25K, 35, 100, whatever. You can see 27% in annual cash flow in year 1, around 50% in year 2, around 27% in year 3, and then you see it start to decline. Oil wells have the highest cash flow in earlier years. The reason the second year is a little bit higher is because 11 of those wells are not online yet. They come online later this summer. Then you have all of the 26 wells cash flowing. You get paid a little bit more in that second year. So this deal here is set to do 1.8 to a 2x return, but look at the other thing there. That's based on $70 a barrel oil, not 80, not 90, not 100, but we've already been getting paid $100 a barrel for a few months running now. That is oil, okay? Now let's go over to multifamily real estate. So I'm gonna put a couple things in the equation here. When there's cash flow on a deal, I get a line of credit against my gold and silver right here. I do about a 60% loan to value, even though I can go up to 75 because I never want to face a margin call. I continue buying gold and silver every single month because I'm hedging inflation and because gold and silver are both undervalued. I use that leverage to go into the oil deal, but I also do it on multifamily, especially on cash flow deals. Here's a deal, Douglas Place. We just closed on it a few weeks ago, and we had a really creative position that we were able to get into. This deal is about 121 units in Grandview, Missouri, just outside of Kansas City. And you can see year 1 projections about 5% in cash flow, but year 2, we were able to design a tax-free distribution of capital back to our clients along with the cash flow. Total multiplier on this deal about a 1.8x, but paying a little bit of cash flow. And do you see how there's a high early return of capital on that deal, just like oil? That allows us to redeploy this same logic. Overfund the cash value of the whole life policy as long as we do not hit a MEC limit. We can talk more about that. If you have questions on what a MEC limit is, you can let me know in the comments. And go get more gold and silver, increase that line of credit, repeat the process. I'm going to show you one more deal here and then how you can get started. This is Lumen Woods. This is the development that we have not yet broke ground on. We already own the land and it's entitled. This is set to be Kansas City's first AI integrated luxury apartment complex. It's about 240 units. Now, we already did a deal right next door that's a luxury apartment complex that's 289 units. We've done several deals, full cycle in this area, so we know it very well. So this one is looking to be between a 2.5 and I think if you're looking at that pro forma right now, on a 5-year deal, 2.5 to 2.58x multiple, all right? So the cash flow deals give us cash flow. The development deals you could see are a little bit higher multiplier, just like you see on that Lumen Woods performer right here. And then we've got the oil, okay? Oil is good for killing income taxes, withdrawing from your 401k while your advisor tells you to withdraw slowly so you stay under a certain tax bracket. We say take all of it and multiply it where you can do 1.8 to 2.2x, okay? Here's your write-offs, IDC, TDC, and depletion allowance. Tangible drilling costs, intangible drilling costs. Those are your upfront write-offs in the year you invest, and 15% of your cash flow that you get from oil cannot be taxed, okay? And then on the multifamily, passive income, max bracket 20%, but we use depreciation so we can lower the taxes on that passive income. If you guys want to learn more about how to do this, and if you're realizing right now, wow, this is a little bit less mainstream than my crappy financial advisor gave me, and I want to fire them right now. If you're thinking about that, if that's the way you're thinking, then click the link in the description and show up to my web class, because I teach this for free in detail and show you exactly what I'm doing, and we go much further in depth. I answer all of your questions and you're on there live with me. So make sure to click the link in the description and register for my web class. Again, it's completely free. Would love to see you on there. Appreciate you guys showing up and watching this entire video, and I'll see you next time.